Okay, good morning. I hope you're all well. Let's have a look around the markets and talk about the day ahead, and indeed talk about yesterday. Where should we start? I guess on the equity space, we had quite an interesting divergence yesterday between US stocks and European. You can see this on my charts at the top, the S&P on the left and the DAX on the right. So in the end, and actually it came after the European closed, the S&P was drifting lower. It was quite messy, but then the big move came after the European close with a decent sell-off and then finally a rebound just before the US close. It kind of repaired much of that damage, but of course the S&P closed down on the day. If we just look at interestingly, looking at the S&P chart on a daily basis, we're right in the middle of the range, first of all. But what's interesting here is, well, as it stands, today's candle is red at the moment. So we've actually got 3 red candles in a row as this market drifts back after a pretty punchy middle part of last week when we had some pretty strong gains. But compare this to the DAX on the right-hand side, and the DAX has had 5 days straight to the upside. If we look at the daily chart, okay, today's candle is red, if I zoom in a bit, but it's hardly red, and we've had some pretty solid gains here, particularly yesterday where the DAX climbed more than 1% on the day. So a notable divergence when you're looking at US stock performance and Europe. I guess the PMIs on the manufacturing side told part of the story yesterday, with European manufacturing PMIs generally coming in better than expected. Whereas in the US, although the manufacturing PMI was in line, it was the ISM manufacturing number that disappointed, came in below expectations, and also delivered an employment component that was weak, which of course is important when you're thinking about the payrolls data that we're going to get at the end of the week. But I would say perhaps it was more of that was one part of the story and certainly helped Europe push higher, the PMIs. But I'd say in the US, it wasn't so much necessarily the PMI or the ISM number that was the catalyst for the underperformance. I think it was mostly a commodity story, mostly an oil story. When you're thinking about the S&P index, then it is packed full of very large commodity companies, particularly oil, of course, with the likes of Exxon and Chevron. They led the slide yesterday, and that's because the price of oil, again, plummeted. And it's not a coincidence that the big move on the day, if I just make this oil chart a little larger, the big move on the downside on the S&P came after the European close, exactly the same time as the oil price made a big further move to the downside. So you've got still a pretty positive, on the short term, a positive correlation between stocks and oil. This is particularly the case with indexes that carry large oil firms like the S&P. You could also say the FTSE 100. These are indices that are vulnerable when it comes to the price of oil falling. Oil dropped. It's been on a downward trend. If I showed you the daily chart, the story here. This is pretty phenomenal. We're now 28%. If you look at yesterday's low, that is 28% off the high of the year set back in May. Most of that move coming just in the last sort of 5 weeks. This is a big, big move. And in fact, the month of July was the worst down month for crude oil prices since 2008. So that actually includes all the months where we sold off at the end of last year and the start of this year, on a percentage basis, that is. I went to a monthly chart. You kind of see what I mean. We had some monster downside in October, in November, in December particularly. But when you're looking on a percentage term, October, oil was down 11.6%. November, it was down 17.87%. December, we were down 19%. 3 months of absolute carnage in a row here. But that December print at 19.47%, when you look at this print for July, 20.77%. So in percentage terms, because of course we're at much lower prices, so the percentage moves get exaggerated. So actually July is the worst month since October 2008, when Lehman's collapsed and the price of oil dropped 32% in just 4 weeks. So pretty remarkable. But this move in July is bigger than any month we saw as this oil price collapsed and halved, more than halved in value. So we're now in August though. So now that August has begun, well, what's happened? Well, big downside straight away. Yesterday was the first trading day of August. Straight away, 4% drop. So yesterday it was helped along by Iranian comments. This is where Iran were just talking about their likely increase in production beyond the lifting of sanctions. At the moment, there's still a bit of uncertainty on the timing of this, but probably sanctions will get lifted by the end of November. And Iran yesterday was saying the day after sanctions are lifted, we can increase production by 500,000 barrels a day. And they said a month after sanctions are lifted, our output would have increased by 1 million barrels a day. So this helped to push crude ever lower. And I've been talking about $42. This is the March low when you're looking at a continuation chart. And as it stands, I mean, this thing's in free fall. We're still technically, of course, very negative. And so, there's no reason why we can't make a further move down there. And as it stands in the short term, this is bad news for equity indices that carry very large energy components. So, oil was a big story again yesterday. The other things that happened, the bond market space, and again thinking about how is this oil price move and commodities more generally, how's it having an effect on other markets? So we've just spoken about equities there. But what happens with things like bonds and long duration bonds? And actually what we saw yesterday and what we're seeing again this morning is decent upside for long duration bond prices. Look at the Bund here. Powerful move yesterday, breaking up through Thursday and Friday's double top from last week at 154.50. This was a great climb. That was a great support level after it got broken for a classic long, and we're trading up to the 155 handle this morning. If we look on the daily chart, this means we're up through the 50% fib level now, and the clear target is the June high, 155.79. So how does the price of oil maybe have an effect on these markets? Well, here you've got to turn and think about the Federal Reserve interest rate hike expectations. And as it stands, this big wave lower in commodity prices generally in July definitely carries implications for the inflation outlook going forwards. And that's a negative factor, of course, for future inflation. And so you might say that some traders are thinking, well, look, if this price of oil and commodities generally continue to cycle lower here at such a rapid rate, well, then this is going to further depress inflation for longer, so the Fed will hold off and hike not in September, they'll wait till the end of the year. So you could say there's an inverse correlation between oil and bond prices on the long end for inflation reasons. And so the price of oil dropped yesterday. T-notes had a nice solid up day. The Bund had a nice solid up day, despite the fact that equities were pushing higher. The Bund was pushing higher as well. When you compare the DAX and the Bund yesterday, both had decent up days. Which can't be said when you're looking at the correlation between US bonds and US equities. That correlation was normal and negative. T-notes higher, S&P lower. But in Europe, we had a positive correlation. So it's a little bit funny, some of these correlations, but I'd definitely say oil is very much still front and center, given the alarming nature, the speed at which this thing is dropping. Again, it's really grabbing attention and it's having a big impact on other markets. So you've got to think about this today. At the moment, we've bounced a little bit. I mean, I guess the next major event for the oil price this week will be Wednesday's inventory data. And that's the thing. Was it last week we had a 4 million drawdown on crude prices. We had a 4 million drawdown on crude prices, which is very bullish. Can you mute that, please? Thanks. 4 million drawdown on crude prices, which was very bullish, and yet, that caused a bit of upside for one day. pretty much on Wednesday, and then it's been sharply low ever since. So oil's still very much in focus. Okay. Other news, what helped with the sell-off yesterday? Actually, Apple share prices took a bit of a dump. And this has been, it's been a bad week for Apple. If you go back to last week, of course, their share price dropped pretty heavily after their earnings report. And, I mean when I say heavily, I mean 10%. This is off the back of a little bit of concern and disappointment on the number of iPhones that they actually managed to sell. And so Apple took another move lower yesterday, just based off something else actually, and this is more to do with China and not only the weakness or the concern we have about Chinese growth. That's one thing to be worried about, given it's such an important market for Apple, but also just looking about internally the internal market share. And what we saw yesterday was some stats released about some of the other Chinese up-and-coming smartphone makers. Xiaomi, for example, these are sometimes described as the Chinese Apple because they kind of make similar, the design is, let's just say, surprisingly similar to the iPhone, but they've now got 15.9% of the market share within China. There's another company called Huawei, and they've got 15.7%. And actually this means that Apple are not the biggest player in the Chinese market. Apple's market share is lower than that. And so this is a bit of a surprise. There's now a new threat. Not only is the Chinese economy weak, but also now internally, perhaps Apple are losing a bit of ground to some of these Chinese smartphone makers. This is the Apple share price. What's notable about the move yesterday, this is long term, obviously, you can see, well over 5 years we're looking at here. And let me just reset that. It's a phenomenal climb, of course, from the lows of 2013. We're trading on an adjusted basis after their 7-to-1 stock split. We're trading down below, actually hit $55, April 2013. Here we are 2 years later. And, we're trading up, of course, up to, about $133 on the high. But it's been a pretty big slide. You can't really see it particularly on this long-term chart. But we're back to test the high point that we had in October last year. And more importantly, we're actually down below the 200-day moving average. The red line on this chart is the 200-day moving average, and Apple's share price is below it for the first time since the summer of 2013. We've gone 2 years with this share price constantly above its 200-day moving average, and not anymore. So some analysts, technical analysts, are calling, obviously this is a bearish signal, and they're saying this opens the door for more downside. You can see how important $100 is technically. This was the key top back in mid-2012. Strong resistance there in Q3 of last year before we broke it and then launched higher. But maybe this 200-day moving average break may well see this share price squeeze further lower, with $100 very important. But we've got a long way to go to get to $100. That would be another sort of 17% drop from where we are. So we'll see. But of course, Apple's the biggest component of these indices, like the S&P and the NASDAQ. And so, when you're getting Apple under pressure, as well as ExxonMobil yesterday because of the oil price, this is what translates through to S&P 500 underperformance compared to, let's say, an index like the DAX. Other stock-specific news may be of interest. RBS, so the Bank of, not the Bank of England, the UK government have announced they are going to be, they placed 5%, they made a 5% placement of stock yesterday. They're beginning to sell their RBS holding. They own 84% of it, so we've got a long way to go here. But this is the UK's government beginning to unwind, the biggest bailout in history. And just check out, I've got a graphic here from the FT looking at how RBS have restructured since the financial crisis. So look on the left-hand side. This is before the crisis. And RBS was the biggest bank in the world. when you're looking at assets, and it's quite, I mean, it's still, I have to say, still quite unbelievable, the size of it. The total assets, $2.219 trillion. Just try and get your head around that. $2.219 trillion, that's one company's assets, which back then, not far off, put it at almost the size of the entire UK's economy. That's bigger than Brazil's economy, it's bigger than Italy's economy, it's bigger than India's economy. Quite extraordinary, and obviously too big. 200,000 employees, more revenue generated outside the UK than inside, 48%. But check out the restructuring. This has been just a phenomenal story. They've more than halved their assets, so they're now only carrying total assets of 945 billion only. But employees have been cut in half almost, only 109,000 now. And look at the revenue generation, 80% now within the UK. So this has been a phenomenal story, and it's not over. They're still restructuring. They're about to get slapped with a monster mortgage mis-selling fine from the SEC that's perhaps reported to be as much as $13 billion. So this is still in the pipeline, still to come. But the UK have decided it's time to begin offloading this, and it will take a long time because they hold such a massive portion of the company. But looking at the share price, unfortunately for us, actually I don't have a chart of the share price, sorry. Unfortunately for us, the share price is trading around about £3.17. It's just that we bought it, when I say we, I mean the government, so the taxpayer bought it just over £5. So it's trading down at £3.17. It was above £4 actually earlier in the year. So pretty substantial downside seen over the last few months. But the UK government's decided to begin the offload, which is probably the right thing to do. I mean, you're seeing this happen in other countries. So Ireland's two big banks they bailed out, they're beginning to offload their holding in those companies. You're seeing the UK government has almost finished its very successful exit from Lloyd's, having made a pretty decent profit off that trade. We will not be making a profit on RBS, unfortunately. Anyway, another stock-specific story. All right, so let's look at the calendar for today. Let me just get this onto screenshot. Give me a second. As I've said, we're mainly focused in on the end of the week with payrolls and average hourly earnings and stuff, but there's still some stuff of interest today. So here in the UK, in Europe, here in the UK, this is the next data at 9:30. We've got construction PMI. The US delivered their construction PMI numbers yesterday that disappointed. On the one hand, the July numbers were disappointing, missed expectations, but there were some pretty punchy revisions higher to the June numbers, which helped to offset that. But we'll get the UK data at 9:30. 10 o'clock we get more inflation-related data out of Europe. And remember last week we had a surprise uptick in core CPI for Europe, which certainly helped move markets. So we'll see here on the producer price inflation side. So this is due at 10 o'clock. Then moving into the afternoon, not too much initially out of the US until we kind of hit 3 o'clock when we get the two main releases. Not that these are that significant, but factory orders are at 3 o'clock, and then IBD, TIP, Economic Optimism Survey. So these are medium, mid-tier data. It's not obviously nowhere near as important as the information flow that we're going to get. The rest, because we've got big data on Wednesday, Thursday, and particularly Friday this week. So I'd say today is actually probably the least interesting day of the week from an economic data point of view. People will be looking at the API inventory numbers tonight for a guide to Wednesday's Department of Energy numbers and thinking about how this price of oil is going to behave as we go into the end of the week and whether this substantial downside is going to continue or not. So this is the look at the calendar. So let's see how we go here. I would say that currently, if I just go to some shorter time frame charts here, let's just have a look at some 1 hour charts across these markets. Then, I'd say you've got the euro-dollar popping higher right now. So that's the pivots have been pretty influential this morning. Euro-dollar's popping higher, breaking its pivot level and moving up. You're getting the Bund do a similar thing, breaking up above yesterday's high. Oil is now also creeping up through its pivot level. So you're getting decent correlation again between the price of oil and the dollar. Dollar weakness here at the moment, leading to the oil price moving higher. Oil's going up. So you might say, well, hang on, isn't that a positive then for, let's say, things like the S&P? And let me just go to a 5-minute chart. And what you've seen is oil has just broken higher, then the S&P has bounced a little bit. So there are some decent correlations to be looked at here. And yeah, let's see how we get on. So data at 9:30, that's in 30 minutes time from the UK, and then some data at 3 o'clock. But by and large, I'd say just be patient. You're probably going to see, it's such a big week that maybe you're going to find investors just hold back and wait until we get key news flow at the end of the week. You may well see that periods of the day are pretty quiet and volumes are low before there may be short bursts of activity as we get maybe technical breaches or we get the data hitting the news wires. But it may be that, well, it certainly will be, that patience is going to pay off in these markets. That is patience not only when you're in trades and allowing markets time to move and reach targets, but also patience in terms of waiting for the key entry points and not allowing yourself to get dragged in at price points that aren't particularly significant just for the sake of having something to do. All right, so that's it for now, guys. Enjoy the session. Data in 30 minutes. Thanks.